Hey guys, this video is going to cover what you need to know about investing in the TSP. We'll get into all the different funds, and then at the end I'll share with you some of the most common mistakes I see people make when they invest in the TSP. So we're going to start off with more of a bird's eye view, looking at the kind of overall picture. What kind of investments are we talking about here? And then we'll dive deep onto each individual fund, talking about what kind of companies they invest in. Is it domestic, international, stocks, bonds, all that good stuff. This video is going to cover the individual TSP funds, but if you need a refresher on the TSP as a whole, I'll have a link down in the description that'll kind of give you a rough overview what the TSP is all about. Okay, so the TSP invests in either stocks or bonds, okay? And for those that need a refresher, a stock is part ownership of a company, and a bond is essentially a loan to that company, right? Generally speaking, stocks are considered the riskier asset and hence a higher return. If a company were to completely fail, in theory, the bondholders would be paid before the stockholders received anything. When it comes to the TSP funds, as you may have guessed, they are mutual funds, okay? A mutual fund is simply a collection of stocks or bonds or both. Just consider it kind of like a grab bag, right, with a bunch of different stocks or bonds thrown in it. So rather than having to go out and buy those individual companies, when you buy a share of that mutual fund, you have a proportional ownership in those various stocks or bonds. All right, so the TSP has 5 core funds. There's 3 stock funds and 2 bond funds. The stock fund options are going to be C, S, and I, and they're going to have the F and the G for the bond funds. And then to wrap it up, you have various L funds, which are simply just various combinations of those initial 5 underlying funds. Depending upon when you want to retire, you would select a particular L fund, and it will automatically adjust the ratio as you approach that goal. The C fund, just think common stock, C for common, and that's going to be your S&P 500 index fund, right? So that's tracking the 500 largest companies in the US. So you're talking Apple, Amazon, Facebook, things like that. So they're, well established, probably not going anywhere anytime soon. C fund would probably make a good kind of base or core fund for your portfolio. The S fund tracks the small cap companies, right? So the small and medium companies that aren't on the S&P 500 index. So Tesla, Square, there's a few others that make up the top 10 holdings, but there's 3,000 or over 3,000 different companies on that particular fund. So you really have a wide base of companies, right? But since they're smaller companies, generally they're considered a little riskier than your large cap. A little more volatile, meaning the price is probably going to fluctuate a little more than the C fund, but probably has a higher return over the long run. So if you wanted to combine those two, you could do the C fund and the S fund together in about a 4-to-1 ratio. So like for every $80 you had in the C fund, you can put $20 in the S fund, and that would approximate the total US stock market. Next up, we have the I fund, which is international stocks. It tracks the MSCI EAFE index, which is the Morgan Stanley index that tracks Europe, Australia, Far East. It tracks 21 developed countries. So some of the big holdings there would be Nestle, Toyota, things like that. Over the last decade or so, domestic stocks, so US stocks, have outperformed international. However, the previous decade, international outperformed domestic a lot. So I'm going to do a separate video explaining why it's important not to get kind of sucked into one particular asset class. Because, hey, just as time goes on, things change, companies develop and grow, economies, natural disasters, whatever, things happen. Various asset classes are going to do better, over time. It's just, they're constantly fluctuating and changing, and it's, anyone's guess really which one's going to do best next. All right, moving on to our bond funds. We have the F fund, think fixed income, F for fixed income. And what that does, it tracks the Bloomberg Barclays US Aggregate Bond Index. It has about 11,000 different bonds on it. And it's combination, about a third or so roughly, between government bonds, right, US Treasuries, mortgage or asset-backed securities, and then corporate bonds. So just, you know, private companies that are trying to raise money to, you know, expand, grow operations and all that. All right, and the last of our 5 core holdings is the G fund. Think government securities, government bonds, okay? The G fund is the only fund inside the TSP that doesn't follow an index, but what it does is it invests in short-term government bonds that are only available to the TSP. The G fund is the only fund inside the TSP that guarantees the principal and interest, but because of that guarantee, the returns are pretty low. Historically, it's been, you know, a couple percent, basically just barely enough to keep pace with inflation. For the longest time, the G fund was actually the default option inside the TSP. They recently changed it to one of the L funds, which I think was a really smart move. Because if someone stayed invested in the G fund, you know, for their whole 20-year career, they're not really going to have a whole lot of growth, right? If it's only earning 2-3%. You know, when you're young, it's much smarter, as a general rule, to be invested heavier in stocks. You know, maybe 90-80% stocks and, you know, the remaining in bonds, so you get a decent rate of return. And then as you get closer to your retirement date, you would want to shift that. But I will do an entirely separate video all about how to determine the appropriate asset allocation. And all the asset allocation is what percentage of your investments you have in stocks versus bonds. You know, with inside stocks, what percentage is domestic versus international, large companies versus small companies, etc. You get the idea. But I'll do a separate video on that, breaking it down so you can figure out what makes sense for your particular situation. All right, to wrap it up, we have the various L funds. There's the L income, the 2030, 2040, 2050, etc. And all the L funds are simply various mixes or ratios of those initial 5 core funds, right? So a 2050 fund, right, that's, you know, 30 years out in the future, so it's going to have a larger percentage of its assets in the CS and I, those stock funds, and a smaller percentage in the F and G fund. Now, as it gets closer to the year 2050, that fund is automatically going to adjust and become more conservative. So the stock holdings will decrease and the bond holdings will increase, making it more conservative, right? Kind of locking in those gains. All right, guys, we got to wrap this up. The sun is going down, but I did tell you I'd give you a couple common mistakes that people make when they invest in the TSP. One of those mistakes is that they will invest in numerous L funds, okay? And there's no point in that. Since the L fund is already comprised of a certain percentage of those various underlying funds, and it's done that way for a reason, if you're mix matching different L funds, then you're just throwing off that ratio. So there's really no reason to do that. The second mistake that I'll see people make is they'll just keep their money in the G fund because they think it's safe. Now, it is true that there's no risk to the principal and the interest is guaranteed as long as the US government is still running. Big picture, long term, they're accepting the risk of that money not growing enough for them to be able to live a comfortable retirement, okay? So when you're young, you can afford to take more risk, and you should do that. All right, I'm gonna do a whole separate video series breaking risk down, all right? Too often we're just focused on the short-term volatility, right? The change in prices, okay? You have to have a long-term view though. When you zoom out the camera lens there and you see the overall picture over a 5, 10, 20-year time horizon, you're almost guaranteed not to lose. I mean, it really is impressive. So I'll do a whole separate video on that, and I'll throw a link up here at some point whenever that's made. All right, guys, that's all we have time for today. Hope you enjoyed the video, got something out of it. If you did, share it with a friend, subscribe so you get some more content, and watch some of the other videos to keep learning and building that wealth. All right, till next time, see you later.